Good morning, everyone. So when you see the market today are extremely noisy and more unpredictable. See, with opinions, forecasts, and even predictions coming out from every direction. And while this constant flow of information feels kind of like more useful, right? But it often creates more confusion than clarity. Yes. So what I would say is that see, pushing investors towards more emotional driven by fear that the market's going to fall or something like more greed during this market highs and this make more kind of concern over the investors, right? So but the truth is that no one can consistently predict the short-term market moments. Yes, but see, despite this more uncertainty, long-term wealth creation always kind of follow a kind of a more clear and repeatable path, which is rooted towards more to discipline, patience, and process rather than the kind of timing the market more perfect. So when you see the history, kind of the wealth is not built by guessing where the market will be in the next 1 month or kind of next year. But see who all stayed invested through this cycle, who are managing the risk more sensibly and allowing the compounding to work over time. This is why the topic matters so much today, I would say. See, because while markets may remain unpredictable, but when the principles of this success also by keeping the kind of the constant kind of asset allocation where you don't give more importance to timing the market where you beat the kind of expectation of the benchmark and so these emotional reactions are the biggest destroyers of your wealth, I would say. So yes, so in today's session, instead of offering kind of more predictions or stock tips, the focus will be on building a structured investment process where it helps investors to stay more kind of calm during this volatile, more just to make more confident during this uncertainty. Because as you guys know that tomorrow is coming the budget, so it's very important right now at the stage. You should be more committed towards your long-term goals. Also, see the sustainable wealth is created only to the people who have good mindset, I would say. So have a stress-free wealth over time by doing the right thing more consistently. Okay, so see, most investors believe that better predictions will lead to better returns, but the reality is that markets already priced in almost all the information what you know. See, if information is like more easily available than earlier. News, earnings, interest rates, election, and even the expert opinions almost instantly, which is why I would say constantly predicting the market movement is kind of incredibly difficult, even for the kind of highly professional people also, I would say. See, if the market with the full-time research teams even struggle to get the timing right, retail investors are trying to act like by reading the headlines or seeing the forecast are often set up to fail. That's how it works. So not because they lack intelligence, but because the game itself is stacked against predictions based on decisions, I would say. The real damage doesn't usually come from choosing the wrong asset, but from timing mistake, I would say. See, entering after market have already risen or exiting after panic has already set in. So I think there is no use in this both cases. So missing just a few strong recovery days can significantly reduce your long-term returns. So often far more than holding a temporary underperformance investment, which creates a cycle where investors jump in and out, where the market kind of see based on confidence during the highs and even fear during the lows, unknowingly make you to buy expensive things and sell the cheap thing. So this prediction trap, therefore, isn't just about kind of more about wrong on your returns, I would say. It's about disturbing the kind of how the investment itself will be working. So I would say instead of trying to outguess a market that have already absorbed everything what you know, successful wealth creation comes from accepting the uncertainty. It's very much important. So you should always focus on asset allocation, value discipline, and process-driven investing, and allowing the company to do the heavy lifting for you over the time period. So because in investing, avoiding the big mistake matters more important than taking some good bold stand, I would say. So when we kind of see investment in kind of its core, what truly builds wealth is not the brilliance, see, or kind of a bold calls or a perfect prediction, but discipline. See, because markets don't reward intelligence in short bursts. they reward consistency over long periods. Kind of they see the idea of the time in the market. They were like reward consistency or for long periods. The idea of time in the market matters more than the timing the market, I would say. See, uh, since compounding only works when money stays invested through the cycle of optimism, fear, correction, and recoveries. And every time an investor who exists trying to be smart, they risk missing the very important phase that creates long-term returns. Wealth is built by following the repeatable and structured investment process. So one that decides in advance how much to invest, where to invest, and how to respond when the market becomes more volatile. So the decisions are not driven by emotions or headlines. So it's a process focused on asset valuation, as I said earlier, and to kind of participate on the growth while managing the downside risk over time. So this constant, this kind of having the mindset like everything will be right. I do whatever I do, it will be correct. So it's you should have kind of a change of mindset where it replace the ability to invest in a proper way, I would say. So the journey of wealth creation is, as I stated earlier, it will come only through discipline, where the compounding which works in a background, which will provide a brilliance of return over the kind of, it will outpace your momentum of overconfidence. So see, the real power of wealth creation comes from having a clear, well-defined process. Because money grows best when the investment decision is kind of tied back to the purpose rather than the impulse. See, it begins with a clear financial goal. So knowing what you're investing for, whether it's a long-term wealth retirement or financial independence. See, because goals determine both the time horizon and the level of risk you can take comfortably. Right. So once the goal are clear, your asset allocation becomes the backbone of the process, and ensuring your investment are aligned to your risk profile rather than kind of this market noises. So you are neither kind of see overexposed during so this kind of phases nor kind of overly cautious during the opportunities. So consistent investing habit then do the heavy lift for you and allows the compounding to work quietly over time. Then finally, have a regular review and rebalance ensures that portfolio stayed aligned with the goals which you set in your starting space. So as the market move, trimming excess risk when the certain kind of assets run hard and adding where value emerges there, right? So without this emotional decision making, this structural process replaces guesswork with more discipline. So this reduced mistake, so which creates a more repeatable framework that works across a market cycle, proving that the wealth is not built by reacting faster than what you think. So by following the process that mainly steadily make you to work in a better way, I would say. So this goal-based investing is the foundation of building wealth the right way. Because money without direction often leads to the confusion. See, inconsistency or poor decisions written by themselves may look attractive, but without a clear purpose, they are like meaningless. Or a kind of or a true success comes from neither your investment actually help you to achieve in a kind of matter for which is important for you the most, right? So every financial goal, whether it's buying a home or funding your child's education, building retirement wealth, or creating long-term, so as stated earlier, so kind of buying a house or funding your education or building retirement wealth or creating a long-term financial freedom as a different time horizon. So this kind of risk capacity or the required strategy. See, this means kind of like one size will fit all your requirement, right? So simply does kind of everything with a single framework will work. It's not going to happen in that way. So that's why when goals are clearly defined, the asset allocation becomes your logical and a disciplined kind of tool, which ensures that the short-term goals are protected from unnecessary volatile market, while the long-term goals can benefit from the growth-oriented assets. So yes, this clearly helps kind of investors to stay committed during the market ups and downs, and because the decisions are no longer driven by fear or greed, but by aligning with the kind of end objective, right? So in essence, goals give money a clear direction, transform investing from return chasing into a kind of purpose driven planning. and see kind of create a framework where discipline replaces emotion and the long-term wealth creation becomes more achievable, right? So now we can see the important thing, that is asset allocation. See, asset allocation is where investment truly shifts from chasing returns to managing risk more intelligently. Because wealth is not built by putting all your money into what you exciting at that particular moment, but by balancing growth, stability, and diversification way that can survive the different market phases. So equities can play a kind of crucial role in the long-term wealth creation as you kind of work over time. But they also come with volatility, which is why they need to be complete kind of complemented with other asset classes like debt instruments that provide stability and this predictable cash flow, which act as a shock absorbers during the market corrections. So beyond this, there's a core balance assets like we all know right now, gold, silver, which has done a significant rally in the kind of this last year, I would say. And also having a good global exposure also add important layer for your diversification. So they see this everything help to protect your portfolio during the domestic stress, currency fluctuation, and this global uncertainty, and ensuring that the risk is not concentrated in any kind of a single kind of economy or asset class. See, the real power of asset allocation lies in the fact that different assets perform well at different times, and by spreading investment thoughtfully, investors can reduce the dependency on the market. Sorry, see that perfect timing and the market predictions. See, then this structured approach can smoothen the journey, reduce the emotional decision making, and during the volatile time. So, as a whole, this resilient portfolio that steadily compounds across market cycles come through this asset allocation, I would say. So, the another tool I would say is SIPs. The SIPs are the one of the most powerful yet kind of more underappreciated tool in the investment horizon, because they shift the focus from trying to predict the market to building discipline. See, which is ultimately what creates long-term wealth. Market are inherently volatile and unpredictable in the short term. And when investors try to time their entry point, they often end up waiting too long, investing too late, or stopping altogether, like during the periods of uncertainty. So, whereas this SIPs removes this stress and completely by automating investment and ensures money is deployed consistently, regardless of the market conditions. So this consistency enables rupee cost averaging, where more units are accumulated when markets are down and fewer units are being kind of priced at high, I would say. So this lowering the average cost over the time requires an active decision making, which is equally important. So SIPs build behavioral discipline, encourage investors to stay invested throughout the market cycle rather than reacting emotionally to the news, corrections, rallies, see over a long period of time what's happening right now. So this steady approach allows this compounding to work uninterrupted, which matters far more than getting the timing exactly right. So in essence, in essence, SIPs are not only about maximizing short-term returns, but about creating a repeatable stress-free investment habit that aligns with the long-term goals and makes the wealth creation both sustainable and achievable. So before we talk about investing of wealth, it's important to talk about the protection, because an emergency fund is what keeps a good investment plan from falling apart at the worst possible time. See, life is more unpredictable. So due to job changes or medical expenses or family emergencies, and when this happens without any safety buffer, investors are often forced to sell their long-term investment at the wrong time. So locking in losses or derailing years of progress, kind of, see, that's why we recommend keeping at least 3 to 6 months of their essential expenses in a highly liquidable and a low risk instrument. It can be kind of a liquid fund or a kind of a short term debt fund. So not to earn a kind of return, but to have a peace of mind in your investment journey. This emergency fund act as a kind of a shock absorber during the market volatility and personal crisis. So preventing panic selling and allowing your equity and long-term investments to stay untouched and continuing the compounding work for you. So in simple terms, the emergency fund is not about growing money. It's about protecting your investment journey, which ensures kind of a short-term needs, which will kind of not affect your long-term wealth creation journey. So as markets move over time, portfolios naturally drift away from their original location, and this drift often increases risk without the investors even realizing it. So assets that performs well will start to occupy a larger share, while the underperforming one will start to have their percentage allocation to be reduced. But the important stabilizer quietly shrink, so which can leave the portfolio misaligned with the original goal and the risk profile which you made in the starting of your investment phase. So this is where the regular review and this rebalance becomes more critical. So not to chase return, but to control risk and bring the portfolio back in line with what it was designed to achieve. So by periodically kind of trimming what has run ahead and adding to the areas that have lagged. But since the fundamentals remain more soundful and the rebalance enforce more discipline, and this removes this emotional kind of decision making and ensures that the portfolio continues to serve its purpose across the market cycles. So in essence, this review and rebalance acts as a steering wheel of the long-term investment journey, helping the investors to stay a course towards their goal regardless of the short-term market noises. Okay, now, so I would like to introduce M2W. So Milestones to Wealth, which is the structured goal-based investment program built for investors who want clarity, discipline, and consistency during their investment journey. So M2W is designed around the simple idea that wealth is created by following a repeatable process aligned to life goals, by not reacting to this short-term forecast. Instead of asking where will the market go next, M2W focus on the question that actually matters. What is the goal? What is the right asset allocation for the goal? And what level of discipline is required to reach it? The program emphasizes the long-term wealth creation through systematic investment, a kind of more sensible asset allocation, regular review, and behavioral support. What we are providing through this webinars and so, and helping investors to stay invested during this both good and difficult market phases. So in essence, see, M2W acts as a roadmap that converts saving into structured milestones over time. So okay, now let me explain how this M2W actually works in practice, because this is where structure meets execution. So M2W begins with the goal mapping, where we clearly defines what the money is meant you need to achieve, whether it's like for wealth creation or for financial independence or milestone-based goals like 25 lakhs, 50 lakhs, or 1 crore. So along with the time horizon and the risk capacity, see, because without clarity on the destination, investment becomes more directionless. So once the goals are mapped, we break them into milestones which help investors to stay motivated and track progress in a more measurable way rather than obsessing over this short-term returns. So based on the returns and milestones, we designed a kind of this customized SIP strategies, not kind of a generic one, ensure that the investment amount, asset mix, and the pacing align with both the market condition and the investor's cash flow. Then this is complemented by the smart asset allocation, where the equity, debt, the precious metal and other asset classes which are dynamically balanced to manage the risk while still participating in the long-term growth opportunity of India. So importantly, this M2W is not a set and forget approach. We conduct regular reviews to see the accounts for the changes in market valuation, and so due to something like you're not able to contribute, so due to some life situations, making adjustments when needed, while avoiding this unnecessary more churn. The real strength of MW comes by combining the discipline with flexibility. So staying invested through SIPs, using this market volatility as an opportunity rather than a threat to pump in more money, and ensuring these decisions are driven by kind of a clear structure due diligence process, not through any kind of emotional one. So yes, in essence, M2W converts the investment from a more reactive activity into a structured journey, helping investors to stay more consistent, making them with a good clarity and steadily move from milestones to meaningful long-term wealth. Thank you guys for attending today's webinar. So we can catch up in the next webinar. Thank you guys.